Welcome to this episode of Called to Account. As you know, normally I would have my colleague and partner in crime, Paul Croft, filming with me, but given the latest lockdown, and to minimise the gaps between episodes, we thought we might do a few short solo episodes. And today, you've got me. Now, one of my areas of expertise is business valuation. And today I'd like to talk about a particular valuation issue that I know can cause confusion, which is to explain the difference between the valuation of a business and the valuation of the entity which operates it. As you know, a business can be operated by a person as a sole trader or within some sort of a commercial entity, whether that be a partnership, a trust, or a company. Now, where the business is operated within a commercial entity and the dispute at hand requires an understanding of a person's interest in the entity itself, say shares in a company, it's important to understand that the business itself is a specific asset of the company, the market value of which is not necessarily reflected on the balance sheet of the company. So let's just think of a little example. The assets that you might see on the balance sheet of a company that, say, set up and operates a business that manufactures bricks and pavers are perhaps plant and machinery used in the manufacturing process. They'll be shown at cost less accumulated depreciation. You might have stock of raw materials used in the process and stock of any finished goods not sold at the balance sheet date. They will also be shown at cost. And the other assets you might see might be trade and other debtors, a bit of cash maybe, and maybe even the building used to house the factory, which again will be shown at cost. And that might well be it. But if the business is profitable and generates a significant return for its owners, that aspect of the asset is not included in the balance sheet. Now, that aspect of the asset is known as goodwill, or to be all-encompassing, maybe it's fairer to say goodwill and other intangibles. Now, to ascertain the value of goodwill, it is necessary to first value the business, otherwise known as the enterprise value. Now, the enterprise value determined by the valuer and how that is done, I'm not going to cover here. That enterprise value represents the value of the business and includes all of the assets and liabilities of the company which are intrinsically linked to generating the earnings of that business, plus goodwill. So the quantum of goodwill captured within the enterprise value is calculated as the enterprise value minus the net tangible business assets. That equals the value of goodwill and other intangibles. So the enterprise value in this example includes the balance sheet value adjusted to market if necessary of the plant and equipment, plus a normal level of working capital, represented by stock of raw materials, finished goods, trade and other debtors, perhaps some cash required to finance a normal level of working capital, less trade creditors and accrued expenses. Net tangible business assets do not include excess cash reserves, other assets owned by the company which are not an intrinsic part of trading operations, or any debt and other non-business related liabilities. So when the goodwill value is determined, it is then included as a specific asset on the balance sheet of the company. Once that is done, we can then calculate the value of the shares in the company, otherwise known as the equity value, which is the value of the underlying interest held by the owners in the company. The formula, for want of a better expression, for equity value is therefore the enterprise value plus net surplus assets minus interest-bearing debt equals the equity value, the value of the shares. So in our example, after slotting into the adjusted balance sheet the goodwill asset, the bottom line of the adjusted balance sheet will represent the equity value, and it will include the enterprise value in its entirety, as well as the market value of the warehouse the company owns, because that would have been adjusted and that wouldn't be included in the enterprise value, its cash reserves over and above normal working capital needs, and any debt the company has, whether that be bank loans, equipment financing loans, or loans from related parties, all of which are not treated as business related in arriving at the value of the goodwill asset. So there you have it. The enterprise value is the value of the business, which includes all of the things on the balance sheet of the company, intrinsically linked to generating the earnings of the business. And the equity value, the value of the shares, is the value of the entity operating the business, inclusive of all the other non-business related assets and liabilities of the entity. I hope that made sense. Thanks for listening. Until next time, goodbye.